Welcome to this post-election special of Inside the Research with iCM. I'm Pete Seiler, part of our business development team here at iCM, and shortly I'll be joined by Ryan Lehman, our Director of Investments. Ryan, thanks for jumping in today.
Happy to be here, Pete.
So it's been an interesting couple of weeks since we last spoke. We've had a presidential election as well as a Fed meeting. So why don't you jump into things and start with the U.S. elections and give us a quick synopsis of the market's reaction to election results.
Yeah, absolutely. So, as we all know at this point, Donald Trump is going to be our next president. He won in what ended up being a pretty decisive victory over Vice President Kamala Harris. Just as important, though, the Republicans took back control of the Senate and are poised to retain the House of Representatives as well. This is kind of that red wave scenario that I mentioned in our pre-election interview a few weeks back, and was actually in line with what betting markets were predicting, despite running counter to many of those polls out there.
Sure.
So I guess the question then is, what does this mean for markets? So if we start with equity markets, we saw a huge rally in the days following the election, with the S&P 500 ending the week at record highs. And I think this really speaks to the narrative that we discussed last time around the market really preferring certainty rather than uncertainty. And with Republicans sweeping the White House, the Senate, and now the House of Representatives, it's much more clear in terms of what policies are likely to make their way into law over the next 4 years. And those policies being an extension of the Trump tax cuts, likely deregulation, probably a crackdown on immigration, and then the potential for new tariffs.
So in all of that, how did the bond markets take this?
Yeah, bond markets were a little bit more interesting. So rates actually shot up in the day following the election. So we saw the 10-year peak at over 4.4%. And then, interestingly enough, they actually ended the week essentially where they started, around 4.3%. And I think this was likely pricing in a bit of shock post-election, only to have market participants kind of walk back their concerns around the impact that potential spending and those potential tariffs might have on inflation as we look ahead. And I've got a couple really good charts that I'll show here in a second that kind of speak to that narrative. So before we get to that, if we think back to Trump's first term, his rhetoric and his platform, it hasn't really changed that much. Additionally, if we remember, the Republicans, they also had control of the House as well as the Senate for the first 2 years of his presidency. And interest rates and inflation, they were relatively tame during that time. So if we go ahead and just show a couple charts here. So let me just share my screen. So if we start with inflation, Trump started out his term with inflation of just about 2%. And with the exception of that near deflationary period during the COVID pandemic in 2020, CPI actually hovered right around 2 to 3% for the majority of his presidency, which is going to be generally in line with the long-term average. And if we look at interest rates are relatively stable as well, which makes sense given that we didn't really see any meaningful spikes in inflation. Now, again, data is going to be a little bit skewed once we get out to 2020 because of COVID, but for the most part, you saw the 10-year Treasury trade in a range of about 2 to 3%. The only caveat with all this information, though, is that this is anecdotal, so it by no means indicates that we're set up for the same results this time. But thinking back, we didn't see any significant uptick in inflation, nor do we see rates move in any meaningful direction between 2017 and 2020. So we could just be set up for kind of this relatively range-bound inflationary period, and then potentially higher for longer interest rates.
Okay, sounds good. The one thing you didn't mention yet is the dollar. And the big story that we keep hearing is around the impact that tariffs might have on the dollar, in particular, the potential for the dollar to really strengthen.
Yeah, I think that's a great point. And the currency markets are really where we've seen some of the biggest moves, both pre and post election. And as we're recording this right now, we've got the Dixie Index near its highest level in just about 2 years, after it spiked by about 5% or so since just late September. And this is directly in line with that narrative that you kind of laid out, Pete. As betting markets moved in Trump's favor, the dollar's rallied on the back of those expectations for what Trump's going to potentially do when he actually takes office in January. Now, what's really interesting, though, is that the dollar followed the same exact pattern back in 2016. And I'm going to show one more chart here. So we saw this near identical spike in the dollar, with greenback gaining just over 6% from September 30th of 2016 through the end of the year that year. And what many forget, though, is that the dollar fell by more than 10% over the following year and a half as the market realized that much of that kind of extreme tariff rhetoric in the campaign ended up being more of a starting point in negotiations. And that's not to say that tariffs weren't implemented, because they were, but the policies just weren't nearly as extreme as the market originally expected. And the other point I want to make around this in regards to non-U.S. stock performance, and in particular emerging markets, because the other concern is that emerging markets non-U.S. stocks are going to underperform because of all this. And this isn't necessarily true. If we look back to the last time that Trump was in office under the previous administration, emerging markets actually soared during the first year of his term. So they gained 37% versus a return of about 22% for the S&P 500. And I think it's important to note, just thinking about the current valuation environment, we've got a near historic gap between non-U.S. equities and U.S. equities today. And your starting point has typically been shown to have a pretty meaningful impact on your future returns. And with those valuations so low for non-U.S. stocks, so high for U.S. stocks, you really just need to see things outside of the U.S. to not be as bad as expected, and earnings within the U.S. to not be perfect for some sizable outperformance to be possible. And I think all this really just speaks to the fact that investors should continue to focus on the long term, continue to focus on valuations, don't desert diversification, and as always, do not get caught up in the short term. You want to avoid getting caught up in the short term.
Sure. I mean, that's really great advice. And how about we wrap up and let's talk about the Fed and interest rates a little bit?
Yeah, absolutely. So as expected, the Fed cut its target rate by an additional 25 basis points at that November meeting, which was just a couple days after the election. And while they didn't necessarily change their tone, Chairman Powell did note that policy is still restrictive, which leaves more rate cuts on the table for later this year and then additionally in 2025. Now, unfortunately, we didn't get a new set of dots from the Fed. Those are only going to be issued 4 times a year. But what we can look at is movements in rates and then futures markets to get kind of an idea of how this has changed interest rates expectations in the market. So we start with rates. We saw yields initially decline for both the 2 and the 10-year notes, and they kind of retraced their post-election levels in the week following. That said, though, the futures markets actually made some interesting moves post-Fed meeting. So I'm going to pull up one last chart here. And this move really occurred after we got that fresh CPI reading on the 13th. So that report came in generally in line with expectations. And while this normally wouldn't move markets, it did help to squash some fears following the Fed meeting, where Powell kind of mentioned concerns about recent inflation reports coming in a little bit hotter than they expected. So as a result, what we saw is a little bit more certainty priced into that December rate cut. So more specifically, at the end of the week, futures markets were pricing in a 65% probability of the December cut. That's the week following the Fed meeting. And that moved out to about 80% following that CPI report that we got on Wednesday. And additionally, we saw markets pricing in about another 10 basis points or so of cuts in 2025, bringing the total to just over 3 25 basis point cuts by the end of next year, which doesn't seem too unreasonable and pretty closely aligns with that higher for longer interest rate narrative.
With that, we'll wrap up this special post-election episode of Inside the Research with ICM. If you have questions or would like additional information, please reach out to us at 888-426-4689 or via email at info@icm-invest.com. Thanks for watching.